Welcome back to the Deep Dive. Today, we're plunging into the complex and, frankly, quite debated world of Hut 8 Core,
Mm.
ticker symbol HUT, listed on both the NASDAQ and the Toronto Stock Exchange.
Duo listed, yeah.
We've gathered a stack of sources, articles, research, our own analysis to tackle this central question. Is Hut 8 actually pulling off this transformation? Are they becoming the diversified digital infrastructure backbone of tomorrow, really catching those huge AI tailwinds?
Or is it the other side of the coin?
Right. Or is this a classic case of a company, a veteran Bitcoin miner, losing its focus, abandoning its core, right when market interest is peaking, and instead jumping into this really high-risk, capital-heavy gamble that could, well, put its future in jeopardy?
It's a big question, a really big one.
So our mission today is pretty clear. We're here to dissect Hut 8's strategic pivot, take a hard look at its leadership, its financial health, and really try to get a handle on its intrinsic value.
The goal is for you, the listener, to walk away with the insights needed to form your own informed opinion, because this one is dynamic, controversial even.
Absolutely. And just a quick note on the data. We're using publicly available information and financials as of July 14th, 2025.
Right.
And our reference share price is $21.83 from back on July 11th, 2025.
Yeah, and what's really crucial to grasp right from the start is we're looking at a company caught in a delicate balancing act. It presents a genuinely high-risk, high-reward profile. And what's fascinating is how the market seems to be valuing it right now with this kind of equilibrium.
Equilibrium, huh? That's interesting.
Yeah, it suggests a lot of uncertainty is priced in. By the end of this, you'll really understand why the outcome here could be quite binary, either a huge win or a significant miss.
Binary. Okay, that definitely highlights the stakes. So let's map out how we're going to tackle this. We'll break it down into two main parts across 7 distinct chapters.
Sounds good.
First up, we'll get into the company's business, its management, and those all-important financials.
The core foundation.
Exactly. Then, part 2, we'll shift gears to market sentiment, who owns the stock, the major risks, and finally, we'll wrap it all up in our conclusion. Ready to unpack this?
Let's do it.
Chapter 1, Business Analysis. Beyond Bitcoin.
Okay, so Hut 8. Look, they've undertaken this profound, really ambitious strategic transformation. They are not just a pure-play Bitcoin miner anymore. That's key.
Right, so what are they then?
Their new identity, as they frame it, is a vertically integrated energy infrastructure platform.
Okay, break that down.
It's driven by what they call a power-first business model. The core idea is actually pretty straightforward. Acquire and control energy assets first. Get the power sorted.
Before deciding what to do with it.
Precisely.
Right.
Then decide the highest return use for that power. Maybe it's Bitcoin mining, maybe it's high-performance computing HPC for AI, or maybe even other industrial uses. Power first, application second.
And you can see this reflected in their structure now, right? These 3 core segments.
Absolutely. First is power. Q1 2025 revenue was $4.4 million there. This is the bedrock of that power-first strategy. Think energy asset management, direct power generation, even managing power services for third-party clients.
Okay, foundation laid. Then there's digital infrastructure.
Right, the physical backbone. This brought in $1.3 million in Q1. It's about providing the actual data center space, the cooling, the electrical infrastructure, colocation services, basically.
So renting out space for servers.
Exactly. Both traditional CPU servers and those specialized ASIC miners, the chips built just for Bitcoin mining. Super efficient for that one task.
Got it. And the biggest piece.
Compute. That was $16.1 million in Q1 revenue. This is where their legacy Bitcoin self-mining sits. But crucially, it's also home to their main growth engine. GPU as a service for AI and machine learning. That's under the Highrise AI brand. Plus, they do traditional data center cloud services, too.
So compute is kind of a mix of old and new.
Very much so.
Yeah.
And the why behind this pivot is critical. You used the phrase existential necessity earlier, and I think that's spot on.
Why existential?
Because the economics of Bitcoin mining are just notoriously volatile, brutal even, especially after the halving in April 2024, which cut mining rewards in half. This shift isn't just opportunistic, it's about survival. Building more stable, predictable, potentially much higher margin revenue streams on top of the infrastructure they already understand.
So despite the big pivot talk, Bitcoin self-mining isn't gone.
No, not at all. It's still a core activity. It generates that volatile revenue, sure, but it also acts as a strategic baseload, a way to consistently monetize those power assets they control.
Okay, that makes sense. And the other services?
While there's hosting and managed services, they pitch this as a capital-light growth strategy, offering turnkey solutions for institutional clients who want to mine Bitcoin but don't want to build it all themselves.
Right. Less upfront cost for Hut 8.
Exactly. But the real excitement, the strategic focus, is high-performance computing, HPC. That's the main growth vector, offering colocation, cloud computing, and especially GPU as a service for AI, machine learning, even visual effects industries. Demand there is exploding.
And they also do repairs.
Yeah, an interesting niche, miner repair centers. They're a certified micro-BT repair center. It's small, but valuable in that ecosystem.
Okay, zooming out.
Yeah.
What's their scale like? Are they a big fish?
They're significant in North America, definitely. 20 sites across Canada and the U.S. That gives them some geographic diversity.
And power. You said power first.
Key metric, 1,020 megawatts, or MW, of power under management. That's a substantial amount of electricity, the core asset. And their Bitcoin treasury, over 10,000 BTC, 10,273 BTC to be exact.
Wow, that's a lot of Bitcoin.
It makes them the 9th largest publicly traded corporate holder globally. It's a strategic war chest, provides liquidity.
So the value proposition now isn't just betting on Bitcoin.
Not anymore. It's much broader. It's a diversified bet on the explosion in global demand for energy-intensive computation, driven largely by AI.
The monetization flywheel idea. Bitcoin mining secures power and generates cash, which funds the HPC AI side. Sounds smart. What's the catch?
The catch is execution. It sounds great on paper, but building out high-density AI data centers is incredibly expensive and complex. Attracting and retaining those big enterprise AI clients is fiercely competitive. That flywheel needs a lot of capital and successful sales to spin effectively.
Right. And what about the wider trends?
They're riding two huge waves. First, the institutionalization of digital assets. Spot Bitcoin ETFs helped legitimize Bitcoin, providing tailwinds for their treasury value and maybe mining profitability eventually.
And a second.
The AI compute demand tsunami, just insatiable demand for GPUs for high-density data centers. Bitcoin miners, with their expertise in securing power and building facilities, are kind of uniquely positioned to pivot into this if they can execute.
Okay, but competition. You mentioned it's fierce, a war on two fronts.
Definitely. On the Bitcoin mining side, they're up against giants. Marathon Digital,
Yeah.
MRI, Riot Platforms, RRT, CleanSpark, CLSK.
How do they stack up, like size-wise?
Well, let's look. Hut 8's market cap is around $2.5 billion. Marathon's is closer to $7 billion, Riot's around $5 billion. In terms of mining power, self-mining hash rate, Hut 8 has about 9.3 exahashes per second.
And then an exahash is...
Zillion calculations per second. Massive computing power. But Marathon has around 30 EHs, Riot around 15 EHs, CleanSpark around 18 EHs. So Hut 8 is significantly smaller in pure mining scale than the biggest players.
So they're not the leader in mining.
Not by scale. And on the HPC and AI infrastructure side, they're competing with traditional data center REITs like Equinix, Digital Realty, huge established players, plus other miners trying the same pivot like Iron, Core Scientific, Applied Digital. It's crowded.
And regulation. Always a cloud there.
Always. In both the U.S. and Canada, there's growing scrutiny on energy consumption. For Bitcoin mining and for AI data centers, that's a significant risk factor. Policy changes could really hurt.
There's high barriers to entry.
Absolutely formidable. Extreme capital intensity, hundreds of millions for data centers, hardware, think mini power plants plus server farms. Energy access and procurement finding sites. Negotiating those crucial long-term, low-cost power deals. It's complex, takes ages.
And the tech know-how.
Specialized technical expertise is vital. Operating these high-density facilities isn't simple. Plus, you need strong hardware supply chain relationships, getting access to the latest chips from Bitmain for mining, or NVIDIA for AI.
Okay, but they must have some advantages.
They do. Brand strength is one. They were one of the first public North American miners. Long operating history, proven resilience through crypto winters.
That counts for something.
It does. Their power-first strategy aims for cost advantages. They reported a 30% cut in energy cost per megawatt hour in 2024. Lower predictable energy cost is key.
Makes sense.
For the HPC side, they're aiming for network effects and switching costs. Get enterprise AI workloads onto their platform, make it hard for clients to leave. That means sticky, recurring revenue, the holy grail.
And their assets.
Unique assets capabilities. Yeah. That diversified portfolio, 20 sites, different energy types, geographic distribution helps, and they have proprietary software like Reactor for managing energy curtailment. That adds value.
Chapter 2. Management evaluation.
Okay, leadership. It's really a new guard here, tasked with this massive transformation.
Who's in charge?
Asher Janut became CEO in February 2024. He's really the architect of this new strategy. He co-founded USBTC, which merged with Hut 8, effectively a takeover. Entrepreneurial background, Forbes 30, under 30 for energy, seems focused on aggressive growth, M&A.
Okay, young, driven. And the CFO.
Sean Glennon, appointed August 2024. This is interesting. Nearly 2 decades in investment banking at Citigroup, specifically in global power, utilities, and renewables.
Ah, so finance and energy expertise.
Exactly. His hiring looks like a very deliberate move to reposition Hut 8, to make them look like a serious energy and infrastructure developer, someone conservative institutional capital can get comfortable with. His background is vital for securing the huge financing they'll need.
How are they on communication?
Generally, yes. High degree of transparency. Monthly operational updates, quarterly earnings calls, regular SEC filings, they put the information out there.
But. I sense a but.
But there's this pattern. Consistent insider selling. We see executives exercising options and selling shares.
Okay.
But what we don't see is any open market buying by insiders. None.
So management is selling, not buying, while telling the public it's a great investment.
Precisely. It creates what I'd call significant cognitive dissonance. Publicly bullish, privately. Well, their actions suggest caution, at least about the near-term price. If insiders aren't buying their own stock on the open market, that's a critical red flag for many investors. It definitely lends weight to the bearish perspective.
Yeah, that's not ideal. What about how they're using capital?
Capital allocation. Well, the US-BTC merger in 2023 was the defining move, completely reshaping the company.
Right, brought in Janut.
Exactly. They secured strategic financing, too, that convertible note from Co2, a big tech investor.
Yeah.
That was a vote of confidence.
And the American Bitcoin spinoff.
A clever strategic move, arguably, creates a separate company for the pure-play Bitcoin mining. The idea is to free up Hut 8's main balance sheet for the HPC and AI build-out. Let the market value the two parts separately.
Makes sense. And still investing in mining hardware.
Yep. Ongoing fleet modernization, investing in efficient Bitmain S21 plus miners to keep that side as competitive as possible.
Okay, what about shareholder returns? Dividends, buybacks?
They're a growth stage company, so no dividend, don't expect one soon. The stock situation is interesting. They announced a $250 million stock repurchase program.
Okay, so they might buy back shares if they think they're cheap?
Yes, but alongside that, they have a $500 million at-the-market ATM equity program.
Which means they can sell new shares directly into the market.
Exactly, diluting existing shareholders to raise cash, and they've been using it recently raised $275.5 million this way.
So they say they might buy shares, but they're actively selling shares.
That's the reality. The ATM is clearly the primary tool right now, funding their immense capital needs. The buyback looks more like a signaling mechanism or just having the option available. It doesn't reflect their current actions.
Right. Actions speak louder. What about returns on their investments, ROIC?
Management says they use hurdle rates for new projects, which is standard, but their current return on invested capital, ROIC, is actually negative 11.56%. Return on equity, ROE, also negative at 8.96%.
Ouch. Not great.
No, it really underscores the whole thesis here. Investors are betting on the future. They're trusting that the capital being deployed now, even though it's currently generating negative returns, will eventually yield superior returns as that HPC business scales up. It's all about future potential.
Chapter 3, Financial Analysis.
All right, let's talk numbers. Revenue growth. It's a story of volatility. Simple as that.
How so?
Well, they had explosive growth in the last bull market. Full year 2024 revenue was up 69%, which sounds great. But Q1 2025 revenue plummeted, down 58% year over year to just $21.8 million.
Wow, what happened?
Direct hit from the Bitcoin halving, which cut mining revenue. Plus, they had some significant operational downtime. So that 2024 growth number, kind of misleading on its own.
Okay, volatile revenue. What about profit margins? Are they making money on what they do sell?
Profitability is severely challenged right now. That Q1 2025 all-in cost to mine one Bitcoin, it reached an alarming $58,757.
$58,000 to mine one Bitcoin.
Yeah. which strongly suggests their self-mining segment is operating at or very near a loss depending on Bitcoin's price at any given moment.
So that pivot to higher margin HPC isn't just strategic, it's...
Critical. Absolutely critical. Their overall net profit margin is deeply negative, partly due to operations, partly due to those non-cash gains or losses on their Bitcoin holdings, which swing wildly.
Free cash flow. Are they generating cash from operations?
That's a significant weakness. They have a history of negative free cash flow, and it's gotten worse with the expansion. Q1 2025 trailing 12 months. FCF deficit was around $251 million.
Burning through $250 million.
Directly resulting from high capital expenditures building out those facilities, which forces them to rely on that dilutive financing we talked about, the ATM program.
Earnings consistency.
Yeah.
Sounds like there isn't any.
Complete lack of consistency. The bottom line is all over the place, driven by Bitcoin price volatility impacting both mining revenue and the fair value of their huge BTC treasury.
Give me an example.
Okay, 2024, they reported $331.4 million in net income, largely due to non-cash digital asset gains as Bitcoin rose. Q1 2025, a net loss of $134.3 million, partly as those assets fluctuated. It signals very low-quality earnings driven by market movements, not stable operations.
Okay, so rough on profitability and cash flow. How's their overall financial stability? Debt.
Actually, their balance sheet looks relatively strong. The debt-to-equity ratio is quite conservative at 0.22. Total liabilities around $283 million against equity of $1.29 billion. That gives them flexibility.
It's not overloaded with debt. Short-term liquidity.
Healthy. Current ratio is 1.26. Current assets of $269.1 million cover current liabilities of $213.2 million, so they can meet their short-term obligations.
And dividends.
Not applicable. High growth phase, no dividends expected anytime soon.
All right, let's try to value this thing. Traditional metrics like PER.
Useless. Completely useless with the volatility and negative earnings.
What do we look at? Relative valuation.
Yeah.
Comparing them to peers.
Exactly. We can look at price to sales, price to book, comparing Hut 8 to Amadro, Riot, CLSK. Hut 8 trades at a significantly higher price-to-sales multiple. It's 15.61.
15.6. And the peers?
They're more in the 6 to 9 range. Marathon 8.93, Riot 8.33, CleanSpark 6.19.
So Hut 8 has a big premium on sales. How do you interpret that?
Two ways. Bullish view. The market is pricing in the future high-margin HPC revenue. They believe the pivot will work and generate much more profitable sales down the line.
Bearish view.
Overvalued based on current performance. The premium isn't justified by today's unprofitable revenue.
Okay, that's relative. What about intrinsic value, like a DCF?
Right, a discounted cash flow model. Tries to estimate worth based on projected future free cash flows, discounted back to today because of risk and the time value of money.
And what does a model suggest? Keeping in mind it's just a model.
An educational DCF model we ran suggests a potential value range of, say, $24 to $30 per share.
$24 to $20, compared to the current price,
around
$22.
Right. But huge caveat, this is illustrative, absolutely not financial advice, and it is highly sensitive to the assumptions you plug in. Garbage in, garbage out.
So what are the key assumptions driving that $24, $30 range?
Okay, first, revenue growth. We used a multi-stage model. Modest growth for the legacy mining business, but very aggressive growth assumptions for the HPC-AI segment. Think 50% plus annually initially, then tapering down over time. That's a huge assumption.
Massive growth needed there. What else?
Profit margins. Assumes significant improvement as that higher margin HPC business becomes a larger part of the revenue mix. Another big if.
And the discount rate. How much risk are we baking in?
A high discount rate, WACC. We use 12% to 15%. That's appropriate given the volatility, the current unprofitability, and the massive execution risk involved in this pivot. Higher risk demands a higher discount rate.
Chapter 4. Market sentiment.
All right, what does the market think? Analyst price targets, surprisingly, perhaps, are overwhelmingly bullish.
Really? Even with the challenges?
Yep, consensus is a strong buy from the 15-16 analysts covering it. The average price target is around $25.75 to $26.64.
So suggesting about 20% upside from the current $21.83 price.
Correct. But that bullishness is entirely riding on the success of that AI-HPC pivot. They're betting the transformation works.
What about recent news, media coverage?
It's a mixed narrative. You see positive stories about the AI pivot, the Coatue partnership, new data centers opening, the American Bitcoin spinoff.
The bull case points.
Right. But you also see plenty of negative coverage focusing on the poor Q1 earnings, those high Bitcoin mining costs, and especially the ongoing shareholder dilution from the ATM program. It creates this sort of bifurcated public perception. Depends which headlines you read.
Okay, analysts bullish, media mixed. What about market indicators? Short interest.
No, this is telling. Short interest is extremely high. 16.68 million shares shorted.
How much is that as a percentage?
A staggering 17.56% of the public float. That means a very significant chunk of the market is actively betting against the stock.
Wow, 17.5%. That's huge.
It is. The days to cover how long it would take shorts to buy back all shares based on average volume is about 2.64 days. That's relatively low, but high short interest always carries the potential for a short squeeze if unexpected good news hits.
So short scrambling to buy could push the price up fast.
Exactly. It sets up this classic battleground stock scenario. You've got the long-term bullish analysts versus the short-term bearish short sellers. A real tug-of-war.
Interesting. And technically, moving averages.
The stock is currently trading just above its 50-day moving average, which sits around $21.96 to $23.12, generally seen as a bullish short to medium term signal.
And longer term.
It also recently crossed above its 200-day moving average, which is in a wider range, maybe $16 and $25.31, depending on the exact calculation. Crossing above the 200-day is often viewed as a technically bullish long-term sign.
Chapter 5. Ownership structure.
Who owns Hut 8? Well, top institutional ownership is substantial. Somewhere between 45% and 60% of the shares are held by institutions.
Big names.
Yeah, BlackRock, Vanguard, among the top holders. That lends credibility. Professional money managers are involved, watching closely.
Okay, institutions are in, but let's revisit those insiders. You mentioned selling.
Yes, and this is the critical data point under ownership. Insider holdings and recent transactions. The consistent trend is insider selling and option exercises.
And the key missing piece.
A complete absence of any open market purchases by executives or directors over the past 12 months. We see people like Director Joseph Flynn, Chief Legal Officer Victor Sima, others, consistently selling shares they receive, often from options, but not putting their own cash into buying shares on the market.
So again, that dissonance. Public bullishness, private actions, suggesting otherwise.
Exactly. It's hard to overstate how significant this is for many investors. If the people who supposedly know the company best aren't buying, especially when they're asking the public to fund their growth via share issuance, it's a major red flag. It definitely adds weight to the bear case.
What about ownership concentration? Lots held by institutions. Is that a risk?
It provides liquidity, which is good. But yes, high concentration means if one or two large institutions decide to sell a big block of shares, it could create significant downward pressure on the price. They have more market impact.
Chapter 6. Risk assessment. SWOT analysis.
Okay, let's pull the risks and opportunities together. SWOT analysis. Strengths first.
What have they got going for them?
Key strengths. That diversified and strategic asset portfolio, 20 sites, various power sources, geographic spread, the significant and growing power pipeline. 1,020 mW managed now, but a huge 10,800 mW supposedly in development. That's massive potential if realized.
The Bitcoin.
The substantial Bitcoin treasury. Over 10,000 BTC, highly liquid, strategic asset, a war chest.
And their history.
Established brand and operating history. They're veterans, proven resilient through crypto cycles. That counts.
Right. Weaknesses. What are the big ones?
Current unprofitability and high costs. Significant net losses, negative adjusted EBITDA recently, and that very high Bitcoin mining cost makes the core business look weak.
Cash flow.
Negative free cash flow and cash burn. Burning cash due to high capex for the build-out. Deep deficit there.
Which leads to?
Reliance on shareholder dilution, using that ATM program constantly to fund growth. Existing shareholders are paying for the expansion.
Okay, opportunities. What's the upside potential?
The big one, explosive demand for AI HPC. This is the primary driver of the entire bull case, tapping into that massive market.
Anything else?
Monetization of energy assets beyond just mining or HPC, maybe selling power back to the grid stability services, options there, and value unlocking via American Bitcoin spinoff. Separating the businesses might allow the market to value them more clearly, perhaps favorably.
Now the threats. What could derail this?
Bitcoin price volatility. Huge impact on their revenue, their treasury value, their ability to finance things, always a major factor.
Competition.
Intense competition from bigger miners, from established data center giants like Equinix. It's a tough fight on both fronts.
And the biggest risk of all?
Execution risk. This is arguably the single greatest threat. Can management actually pull off this incredibly complex, capital-intensive pivot, delays, cost overruns, failing to sign those key HPC clients? Any slip up here could be disastrous.
Right. Regulatory.
Regulatory headwinds. That uncertainty around crypto rules, and especially around energy consumption policies for both mining and AI, an unfavorable shift could be very damaging.
What about broader economic factors?
Sure, interest rates. Higher rates mean higher borrowing costs, increase the discount rate used in valuation, make expansion inherently less profitable.
Inflation.
Inflation directly increases operating costs, capital costs for equipment and construction, compresses margins.
Any specific geopolitical threats?
Well, it's hypothetical but relevant. Think about potential U.S. tariffs on imported electronic components. ASIC miners, GPUs, mostly made overseas. Tariffs would directly hike their capex, lower ROI, slow down their growth plans. It's a potential vulnerability.
Chapter 7. Conclusion.
All right, let's synthesize this. The bull case for Hut 8. It's really a bet on a visionary long-term strategy.
The transformation play.
Exactly.
Right.
Transforming into this diversified digital infrastructure powerhouse. The current unprofitability. Bulls see it as a temporary investment phase, necessary pain for enormous future growth in AI HPC.
And the Bitcoin treasury.
Seen as a strategic war chest to help fund it all. The bottom line for bulls, the stock is potentially undervalued based on huge future earnings potential from the pivot.
Okay, that's the bull view. Now, the bear case.
The bear case is grounded firmly in present realities. The company is unprofitable now, it's burning cash now, it's diluting shareholders now for a risky, unproven pivot.
And the core business.
The core Bitcoin mining business is struggling with high costs. There's absolutely no guarantee they can win against established giants in the HPC space. Immense execution risk looms large.
And the insider selling.
Coupled with zero open market insider buying, it screams caution. Bears argue the stock is overvalued based on current performance and the massive risks involved.
So bringing back that DCF range.
Right. Our educational model suggested $24 to $30 per share. Again, highly sensitive to those aggressive growth assumptions.
So putting it all together, what's the outlook at the current share price, around $21.83?
It really feels like Hut 8 Corp is in a state of equilibrium, reflecting this profound uncertainty we've discussed. The market seems to be pricing in a moderate degree of success for the pivot, but definitely not a guaranteed home run.
Back to that binary outcome you mentioned.
Exactly. It feels like the investment outcome here is likely to be quite binary. Either the pivot works spectacularly well or it struggles significantly.
Final take. Fair value.
At its current price, the stock appears to be, let's say, fairly valued for its specific high-risk, high-reward profile. It represents a speculative but potentially transformative investment, but only suitable for those with a strong conviction in the strategy and a very high tolerance for volatility and risk.
If you found this deep dive valuable, then you really need to like and subscribe to the Stock Analytics AI YouTube channel right now.
Do it.
Members get priority deep dives on tickers just like this one. And big news, over the next few months, we're covering all of the S&P 500 stocks, and members get exclusive priority access to those deep dives.
All 500. It's going to be intense.
It is. And hey, if you want a one-off deep dive on a specific stock that's on your mind, just drop us a super thanks on YouTube.
Yeah, let us know what you want us to tackle next. And thinking about Hut 8, their aggressive pivot, their reliance on external financing, it does raise a final question for you to ponder.
Go on.
In this increasingly competitive world for AI compute, will Hut 8's power-first strategy actually be enough to win those crucial enterprise clients? Or will they need to develop even more specialized services, maybe unique technological advantages, to truly stand out from the crowd? Something to think about.
And our standard reminder. This analysis was generated by an AI system for educational purposes and should not be considered financial advice. Please conduct your own research or consult with a qualified financial advisor before making any investment decisions.